Okay guys, I got a 5-minute chart here with the NASDAQ futures. These are the micros and a 10 EMA, exponential moving average. We're going to look at a method for trading the 10 EMA, and we would be starting here after the market opens because it's more reflective of the actual momentum for the day. So let's start around here, and what we're going to be looking for, we need if the activity is under the average, we want a up bar, a green bar that's going to have a close below the average. And we're going to want a short below that bar. And then the stop would be here. And the opposite of that would be a red bar above the average that closes above the average. And then we would go long at the top with the stop below the range. Okay, so starting from the beginning here, we're going to go through the day. We have a green bar. Our first green bar is here. So we would have a short in this position if it breaks below. And that doesn't happen. In fact, the next bar, it closes above. So this is now canceled because the activity is registering above the average. So you'd be looking for the opposite. You want a red bar that closes above. Here's a red bar, but it doesn't close above, it closes below. So now the activity is here, but then the next bar, there's a close here. So now we're looking above again. Okay, let's move along here. And now you see that there's a red bar, and it closes above the average. So this would be your buy, and you could see all this potential for the gain. Okay, never triggers a stop. So let's say you missed that. We're going to look at the next red bar. So here's the red bar. It closes above the average. We would set our buy here. But then we get another red bar here. And this is a better position. So we're going to consider this because it closes above and it is pointing down. So this would be our actual entry. And the stop is never triggered because that would be down here. So we would go from here, potentially up to here. And you could take profit at your discretion. All right, so moving along, we come to another red bar here. There's no trigger of the buy above it. We've got another potential here, same thing. Remember, we're looking for the close above the average. We have it here, but there's no buy signal. Okay, so next we close below, and now we're going to be focused on a green bar, and here's one right here. And we would be shorting right here. We get it on the next bar, and you could see that the activity started up here, so the direction would have been in here, shorting down, and then it comes up. It doesn't trigger a stop. It continues down. You could get even more and maybe a little more. So, you know, at your discretion. Now, we have another green bar here, another opportunity. But that never gets triggered, and we get a close at this point above. So we're moving to the next red bar. Right here. We want a long above here. We don't get a trigger here. We get the trigger here as it breaks the top. And then it closes, and then it goes to the next bar, which looks like it probably, I don't know if it went up here or down here first, but if it went down here, it would have triggered our stop. So one loss, but it would have been this much from here to here, right? We're in here, we're out here, trade's done. Look for the next opportunity. This one, never go above, so we don't enter that trade. Next one, we're going to move down to below the average, and here's a green bar. So this is our first opportunity. We would be short here and possibly stopped out here depending on which way it went. But, you know, you may not have taken the profit here. But then it closes and you have another green bar, which means another signal. But that's way down here. And, you know, you kind of want to consider, in some cases, the distance between, the bottom of this to the average, because the price is going to want to tend towards the average. So, for example, here's a good example here. we got a green bar, closes below the average. Your short would be here, but so far from the average. It's almost 2 bar lengths. So, the averages may work in your favor, but also your stop is big. Your stop is big from here to here. So, something to consider. Coming back to here, we close above. Then we get a red bar. We would be long here. We don't see anything. We get another red bar here, a little lower. That gets barely triggered, and you'd be stopped out if you were to get in there. It's another small bar. Tends to be pretty frequent that we've seen small bars for the losses here. Next bar, we're closed below. So now we're looking for a green bar. We get it over here. Like I said, it's way out there. Now we don't have hindsight and benefit. We could be dropping. But anyway, it doesn't get triggered. So we're okay. We have another green bar. That doesn't get triggered. This one doesn't get triggered. Right? We're looking at the close below the average. Next bar closes above the average. These are all canceled. Then we have a green bar. This is just above the average, so I would consider that. Way up here, but then we don't get triggered on the next bar. When we get to this bar, we have another close that's lower, that has a lower high, so we would be in here, and we'd make all this profit. Let's see, if we were here, we could take this trade. If we gotten out of it, let's say we get another opportunity here. Yeah, this could be a trade right here. Sure. Could get stopped out. Get in, get out, closes, triggers the stop. Then you got this bar to consider, which we don't have a close below the average. We have it. The buy would be triggered right here, and it would continue up. We have another opportunity here. Same thing. So I'm looking for the next red bar, and that's right here. And we would be able to buy right here, and that continues up. And that's it. We're at the end of the day. So market's closed, and we're done for the day.